Most investors are quietly sabotaging their portfolios and they don't even realize it. The worst part is, these mistakes are 100% avoidable. Today, I'm breaking down the 4 biggest mistakes I see investors make and exactly how to avoid them so you can stop burning cash and start growing wealth. I've seen these mistakes wipe out years of gains, and I've actually made a few of them myself. If you can fix even just one of them, you'll be ahead of most investors out there. And stick around for the last one. It's a mistake I see even the most seasoned investors make, and it can wipe out your entire portfolio overnight. Let's get into it. Mistake number 1 is chasing the hype. Buying a stock just because it's trending on social media or it's all over the news is the quickest way to lose your money. During the meme stock craze in early 2021, GameStop went from $17 to $483 a share. Today, it's down over 85% from that peak. Or take Tilray. It was a cannabis stock that was trading over $300 a share during legalization hype in 2018. Now, it trades for 60 cents a share. And here's why the data matters. A study from the CFA Institute found that retail investors who buy after huge run-ups underperform the market by over 4% annually. Think about that. That's the difference between turning 10K into 48K in 20 years versus turning that money into 72K if you had just followed the market. And it's not always that these companies are bad. A lot of these companies are actually decent. The problem is when you buy during a hype cycle, you're paying for the peak price when optimism is the highest. This means even the smallest disappointment can tank the stock price. This happens because of FOMO, the fear of missing out, which tricks you into thinking the momentum will last forever. History shows it doesn't. The early investors are the ones who take the profits, the latecomers are the ones who are holding the bags forever. The fix? Only buy when you fully understand the business model, the financials, and the long-term competitive advantage. I use a 30-second rule. If you can't explain how a company makes money in 30 seconds without looking it up, don't buy the stock yet. Now, even if you avoid the hype, there's another trap that's slowly killing your gains, and most people think this is actually a good thing. Mistake number 2, over-diversifying. Diversification is great for reducing risks, but too much can kill your gains. If you own 40 to 50 random stocks, you're basically just matching the S&P 500, but with more work, and you're more likely to underperform the market. Morningstar research shows that diversification benefits flatten out after about 20 to 25 stocks. Going from 5 to 15 stocks drastically reduces risk, but going from 25 to 50 barely changes anything. Here's a connection. Every stock you add beyond that point is reducing the impact of your winners. Say one of your 50 stocks doubles in value. That's only a 2% boost to your overall portfolio. Compare that to owning 10 stocks. Now a double means 10% of your overall portfolio. This mistake happens because more people think owning more stocks automatically means more safety. But excessive diversification can actually hide your underperformers and drag your returns down to mediocrity. The fix? Focus on a core set of high conviction positions. For me, that's usually 8 to 15 stocks or a mix of ETFs with a few individual names I know inside and out. If you want broad market diversification, own an ETF like VU or QQQ that's going to track a market index instead of owning a bunch of random positions that you can't keep up with. Don't get me wrong, I'm not saying by any means diversification is bad. Diversification is one of the greatest tools and is often known as the only free lunch in investing. It becomes bad when the 40 or 50 stocks you own are a bunch of random companies that you don't know much about. The best way to counteract this is hold a few core ETFs and then hold your highest conviction individual companies as well. Okay, but now, even if you know the right amount of stocks to hold, one emotional decision can wreck your portfolio overnight, and this happens all the time. Mistake number 3 is panic selling on the dips. Selling great companies on a downturn is how you turn a temporary paper loss into a permanent one. In March 2020, Amazon fell over 25% in a super short amount of time. Investors who panic sold missed a 90% gain the next year. During the 2008 financial crisis, the S&P 500 dropped over 50%. Investors who sold at the bottom locked in massive losses, but those who stayed invested saw massive portfolio rebounds and eventually saw their portfolios hit new all-time highs. JP Morgan's research shows that just missing the 10 best days in the market each decade cuts your returns in half. And here's the kicker. Those best days often happen right after the worst days. That means if you panic sell during a drop, you're almost guaranteed to miss the rebound. Think about it. If you start with 100K and sell during a 20% drop, that money is now 80K. Now if you put that 80K back in the market and the market recovers 20%, you now only have 96K. You've locked in a loss even though the market has fully recovered. This happens because of loss aversion. The pain of losing money feels about twice as worse as the pleasure of gaining money. That emotion drives us to make poor decisions at the exact wrong times. Here's a fix. Have a sell plan before you even buy. Decide if you're going to sell this stock if the fundamentals are broken, your thesis has changed, or the valuation has gotten too high. Never sell just because the stock price has gone down over a few weeks. One pro tip, set alerts for earning reports or major news instead of constantly checking the price of the stock. And finally, there's a mistake even the most experienced investors make, and when it hits, it can destroy years of gains in just a matter of days. Mistake number 4 is ignoring risk management. Even the best companies in the world can face unexpected disasters. In 2015, Volkswagen lost over 30% of its value in a week during the emissions scandal. In 2022, Meta lost over $25 billion in a single day because of a poor earnings report. That's the largest one-day drop in US history. Portfolio Visualizer backtests show that portfolios with no position limits have 2 to 3 times higher drawdowns and volatility than those with max allocation rules. Without limits, a single bad stock can erase years of gains. With limits, that damage is capped. And the scary part is, overconfidence is normally the cause. You think a company is too good to fail, so you let that company take up 40 to 50% of your overall portfolio, and then just one bad event can wreck your gains. The fix, set hard rules. For example, no single stock over 50% of your portfolio and diversify across sectors. You can still have high conviction, but you protect yourself from wipeouts. And risk management isn't just about percentages. You think about geopolitical events, regulatory changes, or even currency moves that could hurt your company, especially if they operate globally. If your portfolio is all in on one sector or country, you're exposed to risks you might not even see coming. The difference between a great investor and a bad one often isn't about stock picking, it's about discipline. Avoiding these 4 mistakes doesn't just protect your portfolio, it gives your winners room to grow. The fewer mistakes you make, the more compounding has time to do its job. And over the long run, that's where real wealth is built. It's not about becoming perfect overnight, it's about slowly taking steps to better yourself. What's the biggest mistake you've made? Drop it in the comments. I read every single comment, and maybe your comment will turn into a future video. I'm going to close this off by saying this is not financial advice. These are mistakes that I've learned and I've made myself, and I wanted to share the knowledge to you. Before picking any stocks or investing, you should always do your own research. Thank you for watching, and I'll see you in the next one.